In the light of high commodity prices, rising inflation in the emerging markets, and oil and gas prices climbing sharply, many investors are looking for safe havens. With us today is Joe Prendergast. He's head of currency and commodity strategy at Credit Suisse and a member of the bank's Global Economics and Strategy Group, the so-called GESG. Joe, let's first have an overview over the global economy. Where does the GESG identify risks and where does it identify opportunities?
Well, for the GESG Group, the really key point is that the global economy remains quite robust. And that fact means that a lot of the risks we are presented with along the way, as long as we believe they don't seriously threaten the global economic outlook, which at this stage we do not think they do, then these risks and pockets of volatility really create opportunities in markets. So with that positive backdrop on the economic side, which we still believe in, we really see some of the volatility that we're seeing in markets now as more a buying opportunity at this time.
Oil prices are making headlines at the moment, with the latest rises due to especially the tensions in the North African region. What are your views on oil?
Well, I think for us, if oil prices are rising just because the global economy is doing well, we don't perceive that to be a major threat by itself. It's perfectly consistent with the outlook. If oil is rising due to possible supply disruptions from some of the risks that you mentioned, especially in North Africa or possibly, of course, the Middle East, if that were the case, then we could have quite disruptive spikes in the price of oil, which could really threaten at least the short-term outlook for markets. On the news we have at the moment, the information we have at the moment, we would not particularly expect major supply disruptions in oil. And so while prices will probably keep a decent risk premium in them, so I don't think we're going to see oil prices fall back much anytime soon, I think from a global markets point of view, we're not really at levels that are totally inconsistent with what's going on in the global economy, and therefore we can remain at least strategically constructive.
What is your take on the currencies at the moment?
Well, I think the currencies, really the major currencies, are quite locked in ranges right now at this time. We have a fundamentally positive view on the euro based on the widening yield spreads, euro versus US. But with so many risks and tensions in the world, and in the worst cases of the kind of things on the global economy or whatever it might be with markets, the dollar could do quite well if you get the worst situations. I think that's going to keep us relatively range-bound. We see dollar fundamentals as really distinctly negative, but the risk side of the equation tells you you don't want to be too aggressively short dollars, and so it's a fine balance. So those positive fundamentals a little bit offset by the balance of risk and reward we have. So it's quite a neutral outlook for the really big majors at the moment.
Investors appear worried about inflation. What are your views?
Well, inflation, of course, has been rising around the world, very much led by the emerging markets, following on from rising commodity prices in the last year or so. In the developed world, however, inflation is actually really quite subdued, and overall inflation does remain really under control. I think this is very importantly means that central banks, of course, can also remain relatively relaxed in terms of their pace of returning to a somewhat tighter monetary policy. So we might have some further upward price pressures over time, but really these do remain quite subdued.
We've had a rather positive fourth quarter earnings season. What does this mean for the equity markets?
Well, the equity market outlook strategically, we think, is still very positive. Earnings, as you've mentioned, have been surprising significantly to the upside, and that's obviously very supportive news. We also have a tremendously positive situation with corporate cash being very high as a proportion of assets. There really is a tremendous potential for the corporate sector to provide ongoing support, both to the economy and, in fact, directly to the equity market. And I think these factors will continue to keep us well underpinned. We should also remember that with the global economy doing well, equities should also generally be doing well.
And what are the risks to the equity markets, both in the developed and the emerging markets?
Well, I think clearly we have quite a volatile situation right now, which throws up quite a few potential risks, and certainly, let's say, some potential price volatility. This is also coming after quite a decent rally, of course, especially in the developed equity world. So, there certainly are risks of correction in the near term, and we obviously will monitor very closely what's happening geopolitically in the world to see just how strong those risks could be. I think for the emerging markets in particular, we have, of course, been in a corrective mode relative to the developed world, and I think that is going to probably continue a little bit further in the near term. The emerging world is where, of course, inflation is a little bit higher. Okay, we have higher growth as well, but that also means we're seeing central banks a little bit more biased to tighten, and we've seen currencies going up. And of course, that's potentially going to compress emerging market equity performance relative to developed market equity performance. As we go through the year, I think we will come back to see emerging markets actually perform quite well.
Can you also give us your views on the bond markets?
Yes, and of course bond yields have been backing up in line with the relatively strong global picture that we've had, and of course the little bit of a rise in inflation that we've had. The bond markets probably now discount any really likely pace of tightening we're going to get from the major central banks in the next 12 to 18 months. And that probably means that for the core government bond markets, we're in a much more range-bound environment now. We're not likely to see very much more in terms of yield backup. And that should be very good for the more riskier end of the bond market, so moving into the credit and particularly the high yield area where I think a lot of the higher coupons will attract I think significant interest against a backdrop of relatively range-bound government markets and still a very strong global economic backdrop.
So in a nutshell, where do you see the best opportunities at this point in time?
I would say we would be looking at volatility in the equity market to create buying opportunities, particularly in the developed world at this point in time. And in the credit area, definitely the more medium-term, higher yield credit, I think also looks very appealing.
Thank you, Joe. That was Joe Prendergast, Head of Currency and Commodity Strategy at Credit Suisse. And if you want to know more about the current market situation, visit the website creditsuisse.com/markets.